Have you ever heard the saying that $100,000 is the magic number when it comes to dividend investing? This is often the point at which a dividend portfolio becomes self-sustaining and generates significant passive income. With a dividend portfolio of $100,000, an investor can potentially generate a substantial amount of income through dividends alone. And the math behind it is actually quite fascinating. At its core, this can be achieved by investing in high-quality companies with a history of paying consistent dividends and by focusing on a diversified portfolio that can weather market fluctuations. But how does this work exactly? Well, let's find out. Overview of dividend investing. Dividend investing is a strategy that focuses on purchasing shares in companies known for distributing a portion of their profits back to shareholders in the form of dividends. This approach not only provides investors with regular income streams, but also offers the potential for capital appreciation. By targeting stocks that consistently pay dividends, investors can benefit from a dual revenue stream, making it a particularly appealing option for those seeking steady, long-term financial growth. Reaching the $100,000 threshold in a dividend portfolio is a significant turning point for investors, as reaching this threshold can dramatically enhance the impact of compounding dividends, where the reinvestment of dividends generates further dividends, leading to accelerated portfolio growth. This critical point is the moment when a portfolio begins to sustain and amplify itself, marking the transition from building to expanding. However, the journey to this milestone and its profound impact on an investor's strategy and outcomes necessitates an understanding of advanced dividend investing techniques. One of them being the popular compounding effect. The compounding effect. The compounding effect is a fundamental concept in finance, often hailed as one of the most powerful forces in wealth accumulation. At its core, compound interest refers to earning interest on both the initial principal and the accumulated interest from previous periods. This phenomenon allows investors to grow at an accelerating rate over time, which is particularly impactful in dividend investing. To understand how compounding works, consider a basic example. An investor starts with a sum of money, say $10,000, invested in dividend-paying stocks. Suppose these stocks have an average annual dividend yield of 7%. In the first year, the investor earns $700 in dividends, 7% of $10,000. If these dividends are reinvested, the investor's principal grows to $10,700 for the next year. In the second year, the investor earns dividends not just on the original $10,000, but also on the additional $700 invested, increasing the total dividends received and, thus, the amount available for reinvestment at the end of the year. This cycle of earning dividends on both the initial principal and the reinvested dividends continues each year, propelling the portfolio value upward more significantly with each passing year. The key to maximizing the benefits of compound interest in dividend investing lies in the consistent reinvestment of dividends. By automatically reinvesting dividends to purchase additional shares, investors increase the number of shares they hold, which in turn increases the total dividends they can earn in future periods. This reinvestment acts as a multiplier effect on the growth of the investment, compounding the returns over time. The compounding approach is further amplified by a favorable market environment where the underlying stocks also appreciate in value. Stock price appreciation combined with reinvested dividends lead to a significant increase in the value of the portfolio, not merely through linear growth, but through exponential growth, thanks to the compound interest. The exponential curve of growth that compounding can create is stark compared to the linear growth that would result from merely collecting and spending dividends. In practical terms, to harness the full potential of the compounding effect, Investors should look for dividend stocks or funds with a track record of stable and increasing dividends. This not only ensures a reliable income stream, but also increases the likelihood of dividends growing over time, which is crucial for compounding to work effectively. Moreover, opting into dividend reinvestment plans offered by many companies and funds automates this process, removing the temptation to spend dividends and ensuring they are consistently reinvested to maximize compounding. Achieving escape velocity. Something else is the concept of escape velocity in portfolio growth. This is drawn from physics, but has found a metaphorical home in finance, particularly in investment growth. In physics, escape velocity refers to the minimum speed needed for an object to break free from the gravitational attraction of a massive body without further propulsion. In investing, escape velocity describes the point at which a portfolio's growth accelerates significantly due to the effects of compounding returns, reaching a self-sustaining state where its growth becomes self-propelled. Achieving escape velocity in a dividend investing portfolio means reaching a critical mass where the dividends generated are sufficient to fund significant additional investments, which in turn produces more dividends, thus fueling further growth without the need for additional capital injections from the investor. This stage is crucial as it marks a shift from active capital contribution to more passive, self-sustaining growth, a significant milestone for any investor. For example, let's say you started your investment journey with an initial amount of $20,000 invested in a basket of high dividend yielding stocks and ETFs. With an average dividend yield of 7%, a variance of 3%, and an annual addition of $5,000, your portfolio will begin to grow. However, the real shift in growth trajectory becomes apparent once your portfolio balance hits the $100,000 mark, which may take about 9 years. At this stage, your first annual dividend is $7,000, 7% of $100,000, which is automatically reinvested to purchase more shares. As these shares generate their dividends, the reinvestment cycle continues, each year adding more to the portfolio's value than the year before. The dividends will begin compounding, and with such a huge amount, the capital is also appreciating exponentially, and the growth curve of your portfolio, initially linear, starts to steepen, resembling the exponential growth curve that is characteristic of reaching escape velocity. 5 years after reaching the $100,000 milestone, your portfolio will have quadrupled, even without your annual contributions, demonstrating the power of reinvested dividends and compounding. The portfolio's self-sustaining growth will have taken off, reducing the need to inject new funds to achieve your financial goals. Achieving escape velocity is pivotal for long-term financial planning, especially for retirement. It signifies the point at which an individual's investment begins to generate enough return to potentially cover life's expenses without depleting the principal, truly embodying the concept of living off one's investments. But to be able to achieve this, regular portfolio monitoring to ensure proper diversification and alignment with risk tolerance is essential. Monitoring and rebalancing your portfolio. Well, regular reviews allow you to assess the health of your investments, while rebalancing helps maintain your desired asset allocation, thereby managing risk and potentially enhancing returns. A key component of monitoring a dividend portfolio is setting up a regular schedule for review, monthly, quarterly, or annually, depending on your investment style and the volatility of the assets held. During these reviews, look at each stock's performance relative to the market and its respective sector. Consider not only the total return, which combines the dividend income and capital appreciation, but also how consistent the company has been paying and increasing its dividends. Performance metrics such as dividend yield, payout ratio, and total returns are essential. The dividend yield will tell you how much income you are receiving from your investment dollar, while the payout ratio can indicate whether those dividends are sustainable. Total return is critical because, ultimately, you want your investments to grow in value. Performance metrics extends beyond just financial figures. It's also crucial to watch for any significant changes in the company's leadership, strategic direction, or market conditions that could affect future dividends. Changes in regulatory policies, competitive dynamics, or economic indicators can all signal the need for adjustments in your portfolio. When it comes to rebalancing, the goal is to realign your portfolio with your target asset allocation. Over time, some investments may outperform others, leading to an asset mix that may no longer meet your risk tolerance or investment goals. By rebalancing, you sell off portions of your investments that are overrepresented and buy more of those that are underrepresented. This practice can help lock in gains and invest more heavily in underperforming areas that may be poised for a rebound, maintaining a balanced approach to risk and potential returns. Deciding when to sell dividend stocks is another crucial aspect of portfolio management. There are several scenarios where selling might be the right decision. If a company cuts or eliminates its dividend, it's often a sign of trouble, such as deteriorating financial health or shifting strategic priorities that could negatively impact future returns. Similarly, if a stock has seen significant price appreciation and becomes a disproportionately large part of your portfolio, it might be wise to sell some of your holdings to rebalance your portfolio and reduce risk. Another reason to consider selling is if the company's fundamentals have significantly changed in a way that no longer fits with your investment strategy. This might include changes in the company's competitive position, financial stability, or growth prospects. Lastly, your personal financial goals or needs might change, prompting a shift in your investment strategy. For instance, if you are nearing retirement, you might prefer to shift towards more conservative investments. Regular monitoring and timely rebalancing of your dividend portfolio are not just about optimizing financial returns, but also about managing risk and ensuring that your investments continue to meet your long-term financial objectives. Talking about long-term objectives, this is another thing you need to consider for success. Planning for long-term success. Incorporating dividend stocks into your retirement plan can provide a reliable income stream that supplements other retirement benefits such as pension and Social Security. Dividend-paying stocks offer the dual benefits of income through dividends and potential capital appreciation. To build a retirement-focused dividend portfolio, consider stocks with a history of stable and increasing dividends. This indicates that the company is not just profitable, but also committed to returning value to shareholders consistently. It's crucial, however, to balance this with an assessment of the company's long-term viability and the overall risks associated with the market sector in which it operates. When planning for retirement, it's essential to focus on companies that operate in industries known for longevity and resistance to economic downturns, such as utilities and consumer staples. These sectors often provide more stable returns, which are ideal for retirees who need consistent income. As retirement approaches, the strategy should also shift slightly from high-yield stocks to those with a strong history of dividend growth, as this can help combat inflation over time. Furthermore, sustainable investing with dividends is increasingly becoming a priority for many investors, especially those who are mindful of their environment and social impact. Investing in companies that not only pay dividends, but also commit to sustainable business practices can fulfill both financial and ethical objectives. Many companies in sectors like renewable energy, water management, and sustainable consumer goods offer dividends and are involved in activities that contribute to a more sustainable future. To engage in sustainable dividend investing, look for companies with strong environmental, social, and governance ratings. These companies are often better positioned for long-term success because they are proactive in managing the risks associated with environmental regulations and social responsibilities. Moreover, Firms that lead in sustainability often experience less volatility and could provide more stable dividends, appealing attributes for long-term investors. So now, how do you feel about unlocking the potential of your dividend portfolio? Intrigued by the idea of achieving escape velocity with your investments? Let us know in the comments below. Don't forget to hit that thumbs up and subscribe for more insightful financial content.